You're talking about years before we get inflation because we just don't have a lot of growth right now. The story has been over the last month that the economy slowed from August into September. What do you see from your perch in Chicago?
I think the economic recovery has been pretty good. In fact, it's been a little quicker than I was expecting back in June when I submitted a forecast. I had been quite nervous about there's a normal recovery where we get back to the level of where we were going into this sometime in 2022 maybe, and then we seem to have been doing better than that. Even though the COVID caseloads have been very, very high in the U.S. and deaths have been 200,000 and more, we've continued to be able to grow through this. The last employment report was probably a little more modest than many were expecting, and so I think there are real questions as to how much more quickly we recover after this. But I think we're trying to figure out where the labor market is going to settle out, how much improvement we're going to get in terms of, bouncing back from when we were closed down, and how much recessionary dynamics we're still going to be faced with sometime in the spring of next year. In that environment, I do think that inflation is going to be weak. We could get some relative price changes, which lead to higher measured inflation for, a time, but I don't think that's likely to be persistent, but we'll have to see.
Well, what are business leaders in your district telling you about growth and employment?
It depends on the sector that you're in. So I think the manufacturing sector has been able to, get back to 95%. I think they figured out how to produce safely in an environment where they're not dealing with the end user directly. So they're just trying to figure out how to engineer a safe environment where everybody's socially distanced. They've got plexiglass up when they need to. And then different goods are easier to produce than some others, but they've largely figured that out. I think a lot of businesses, and then of course services, if you can work remotely, you've got a lot of national service businesses where people are, working from home. That's where I'm working most of the time when I'm not here in, a studio. So, but then you've got people who are, dealing with end users directly, consumers, entertainment, travel, leisure, restaurants, and all kinds of things. And so, that's much more challenging. And I think that state and local governments are kind of disadvantaged by this too, because tax revenues are down and they've got to balance budgets. And so there's concern that employment levels aren't going to be as high as we would like there. They cover about 10% of national employment. If they have to balance their budget by laying off a lot of workers, that's going to be, kind of a challenge. So I think everybody's sort of struggling with the same kinds of issues. And, you might have a local employment environment that's better than that because you've just got the right industries, and that's just a happy thing if you're finding that. But I mean, nothing is happy in this case, but you're better off.
One of the big concerns out there is the end of forbearance and the increase in defaults, commercial real estate impact. What are you seeing from there?
Well, that's a great question because, just as I was finishing that last response, I was kind of thinking, for all of the, national service type businesses that you've got workers working at home, they probably have a lot of office space that's lying vacant or maybe 10% occupied. When I do talk to, different financial services providers or others who have brought back maybe 10%, maybe 15% of their workforce, you've got a lot of empty office space. And what's the future going to look like? So I think that, real estate values for office space are, going to be challenged until we get on top of the virus with the vaccine and therapeutics. So I think those are concerns.
Well, you said in your speech this morning that you anticipate in your forecast more fiscal stimulus. Have you modeled what happens if we don't get it? Can you give us a picture of what we would see if they don't provide additional stimulus in the months to come?
Well, I am hopeful that there is going to be more fiscal stimulus, and whether or not, I think I've got, like $1 trillion, which is, not as large as some proposals, but, that does have that effect on the forecast. I think if you take that away completely, then that reduces aggregate demand by quite a lot. And that, means that the road back in terms of employment is going to be a lot harder. I can't begin to guess how this is going to work its way out. I think the timing timing is actually important for a lot of people who are, facing rent payments, mortgage payments, can't go back to work. And what type of unemployment relief might they be facing. Small businesses, whether or not they're ever going to be able to reopen or whether or not they have to close permanently. So timing might be important for many other types of relief. If it came, in the first quarter and it was substantial, then aggregate demand would probably still be strong and it wouldn't affect my national outlook that much. But that's really where, the discomfort with all of this, plays out, because I can talk about a national unemployment rate coming down to 5.5% at the end of next year if things go well. But that could mean that there are large segments that have much higher unemployment that are struggling to get back to work, to put food on the table and pay rent. So it's a very uneven recovery, and there are many disadvantaged sectors and workers, which is really it's a challenge for everybody, I think.
Well, if we don't get stimulus, if the economy is slowing, is there anything more the Fed can do to stimulate the economy? Or with interest rates at zero, you've pretty much done what you can?
Well, I mean, we're going to use all our tools available, and we're going to, be paying attention to what the state of the labor market is, how the economy is growing, where inflation is. At the moment, I think that we are still trying to figure out where the recovery is going to sort of stabilize in terms of what normal recessionary dynamics might look like. So if we were to get additional stimulus, if we were to see continued recovery, if we got the unemployment rate down to 5.5% by the end of next year, those are circumstances where the Fed, we're in the ballpark of what we can deal with. Inflation could be, moving towards our 2% objective, and things could be improving. But I think we're going to have lower for longer interest rates, for quite some time. It'll probably be uncomfortable for many people. We just need to get inflation up to 2% and beyond so that we can average 2%. We need to ensure that the labor market continues to improve. Fiscal support would be extraordinarily welcome. Continued business investment, businesses deciding that they've figured out how to grow in this new environment and bringing on more workers, that would be very welcome. But, it's going to have to play out. And the virus, spread is going to continue to be important for quite some time.
You said in terms of the Fed's new framework this morning that you can't be timid in terms of trying to get inflation above 2%. What does having inflation above 2% for some time mean to you? How much higher than 2%? For how long? What does not being timid mean?
Well, I think we've got to overshoot 2% for sure. I think if we don't get inflation to 2% this cycle, if something happens and inflation doesn't get to 2%, I mean, our credibility really rests on achieving our dual mandate objectives, and 2% is an important part of it, especially when we've been underrunning it for so long. So I think we have to, cross over beyond 2% with some momentum so that we get up above. I would be quite pleased if we could get inflation, core inflation, up to 2.5% for a time, because then that would indicate that we are really balanced in our perspectives. We're able to provide as much accommodation as the economy needs, and it's completely consistent with our objective of achieving 2% on average, because we've experienced inflation down at 1% for periods of time, 1.25% for periods of time. 2.5 is not even a large number.
Well, should we have some kind of Evans rule where you target a specific level of inflation?
I think our current statement gets us very far along the path of very effective forward guidance. We've indicated that we certainly expect to keep the funds rate at 0 to 0.25%, at least until inflation gets to 2%. And it's on track, confidently on track to overshoot 2%. Once we get there, we still can increase rates and be accommodated. The first, few policy moves are still a very accommodated monetary policy, especially if the labor market is as strong as I would expect when we finally start raising interest rates. And so I think we've got the elements of, our past threshold forward guidance. I just don't think that as long as we continue to, speak strongly about we're going to meet our objectives, we're going to overshoot inflation, there's not going to be any concerns that we're going to, preempt that. I think we'll be fine.
Speaking of your accommodation, large corporations can access credit markets easily, but smaller companies, medium-sized companies, still having trouble. And we've been told that a lot of banks at this point aren't really interested in making loans to those companies. How big a risk is that to the economy, and what can you do about it, if anything?
It's very important that the banking system be extremely well capitalized, that it's safe and sound, and that the credit intermediation process can go forward during this time where it's very important, really essential. Businesses that are creditworthy, that can continue, to have positive growth experiences over the future, and are worthy of loans. When I talk to bankers, they are extremely willing to make loans to those types of businesses because they can be profitable for them. I do think that in the current environment where there are these disadvantaged sectors, and it's not exactly clear how the virus spread might affect their future earning capabilities, that evaluating, underwriting those loans is more difficult. The Main Street lending facility helps out a little bit, but it still has to be the case that the bank really thinks that the loan is worthwhile, and that the borrower can pay it back, because they're going to hold part of that risk, given the way that they really are. It would probably be most effective if there was more of a grant-like nature to providing relief for small businesses that are still creditworthy and can continue to survive through this difficult virus situation. Because really, a lot of people really need grants. More debt is not necessarily what they need in order to survive and thrive going forward. But when I talk to bankers, they definitely indicate that they're willing to make good loans. They've got a lot of reserves. They've got a lot of deposits. And the only way that they're really going to make earnings is to make loans. But we're at that point in the cycle where there's always this difference of opinion as to whether or not the business enterprise is really as strong as most people would like. I know when I'm in it, I want to make sure that I can have every opportunity possible. And we're all trying to make that the best situation for everyone at the moment.